Okay, in this example, we are going to change up the previous scenario just a little bit. We are still dealing with a guaranteed residual value of $5,000. You'll remember in the previous example, we actually expected the asset, the piece of equipment, to be worth $5,000 at the end of the lease, which meant that the lessee really did not anticipate having to pay anything over and above the annual lease payments. In this scenario, we are going to change that, and we're going to say, yes, well, we have a guaranteed residual value of $5,000 according to the lease terms, but it is our expectation that the equipment will only be worth $2,000 at the end of the lease. That being the case, the lessee, Vaden Company, will end up having to pay an additional $3,000 at the end of the lease term. So all the other criteria, all the other factors are the same. Now, what that changes, it does not change the present value of minimum lease payments for purposes of classification, wherein we will include the guaranteed residual value, irrespective of whether or not the lessee is going to wind up having to pay anything. What it does change is the calculation of the present value of the lease payments for purposes of determining the liability amount and the value of the right of use asset. In that case, what we're going to include in our calculation is only the payments that we think the lessee will end up having to pay, which means we will include the $3,000 difference between what we're guaranteeing and what we expect the equipment to be worth, which means in this scenario, we come up with a little bit higher value for the liability, $58,354. So let's look at the entries. For Vaden Company, we'll start off on January 1, the same way we always do, debiting right of use asset, crediting lease liability. The only difference really is the dollar amount at which we're recording it, because it includes the present value of that $3,000. Then we'll immediately record the payment for the lease, the first payment for the lease, which again, no interest, so the whole thing will reduce the lease liability. Then at the end of the year, we'll make our entry to record interest expense. Now, that dollar amount will be different than in the previous example. And again, I have attached an amortization table which calculates the interest and lease liability reduction based on this revised balance of $58,354. And then we'll record the amortization expense, which is the $58,354 divided by 4. So no real difference with any of these entries. January 1, we'll debit interest payable, debit lease liability, credit cash, and so on and so forth. So the process throughout the lease term hasn't changed, only the dollar amounts because of a revised liability amount. Now, what will change is when we get to the end of the life of the lease at 12/31/2023, we'll record the last amortization like we have done in the previous problems, but now, because the asset did not retain the value that we guaranteed, we will have to send $3,000 to the lessor. So we'll debit interest expense and debit lease liability based on the amounts in the amortization table, and then we'll credit cash. And that really is the only difference in this scenario and the previous scenario. And of course, we'll be giving them back their asset. Now, on Connor's books, on the book of the lessor, nothing really changes throughout the life of the lease. The amount of the lease receivable is still the present value of the minimum lease payments, including the guaranteed residual value. debiting cost of goods sold, crediting revenue, etc. The first payment, recording interest receivable at the end of the year, and again, that amount will come from the amortization table I created, and those numbers are no different than in the previous example, because either way, for Connor Company, they're going to get $5,000 in assets back at the end of the life of the lease. So we keep going. Again, no entries are any different until we get to the end of the lease. And the only difference you'll notice is that in the previous example, they debited inventory for the full $5,000, credited interest revenue, and credited lease receivable. In this scenario, the inventory is not worth $5,000, so they'll debit inventory for the $2,000 value and then debit cash for the cash payment that they are receiving from the lessee. That's really the only difference for the lessor between this example and the previous example. Okay, let's look at the last example of a finance lease. In this one, our assumptions are pretty much the same. The only difference is that the residual value is unguaranteed. Now, what that means is that Vaden Company is under no obligation to pay that amount back to Connor Company at the end of the lease, either by virtue of the value of the equipment or by virtue of a cash payment. That makes a couple of differences. One difference is that the present value of the minimum lease payments does not include the residual value for purposes of classification or for purposes of calculating the liability. So we are at $55,886 for purposes of classification as well as the liability. Now, what happens then is that we will go through the same journal entries, debiting right of use asset, crediting lease liability. These journal entries really are quite similar to the journal entries with a guaranteed residual value, wherein the equipment retained that guaranteed value. So if you go back to that example, you'll see the journal entries for the lessee are very much the same. And so we'll just walk through all of those. I don't think there's anything unusual here, and we'll get down to the end of the life of the lease and we're through. So if you go back over to the journal entries on this example where we guaranteed the residual value, but we anticipated the asset retaining that value, everything's pretty much the same for the lessee. Okay. Now, for the lessor, it's a little different because now the lessor is the one who is at risk for a decline in value of the equipment. So the lease receivable and the inventory entries are going to be the same. We're going to debit lease receivable for the full $60,000 for the lessor, because for the lessor, that residual value plays into what they get back. For the lessee, it has no impact. Now, here's the difference. Given the fact that the Connor Corp company is at risk for the decline in value of the piece of equipment, the present value of that residual value has to be subtracted both from the cost of goods sold and from the sales revenue. This comes back to the whole conservatism idea of accounting that says I'm not going to account for a value that may not be retained. So we back that out from the get-go. The debit to lease receivable and credit to inventory is exactly the same. So going forward throughout the life of the lease, the journal entries don't change from the previous examples. So in terms of interest, receivable interest, revenue, so on and so forth, those amounts are the same. Now, where there will be a difference is when we get to the end of the life of the lease. What I have done here is I have assumed the example from the previous example, which is that when Connor gets this inventory back, it did not retain its value. It's only worth $2,000. You'll remember in the previous one, what happened was they got a cash payment, and so that made everything all right. Here, because Vaden did not guarantee that, the inventory comes in at $2,000. Connor is going to have to record a loss on the lease because they anticipated a residual value of $5,000. It ended up only being $2,000. Since it wasn't guaranteed, Connor Corporation takes the loss, and therefore you see the debit to the loss on the lease. If the inventory had retained its value, then everything would have been fine. There would have been no loss, and we would have seen a debit to inventory of $5,000. But in this example, I wanted to show what would happen if indeed the inventory did not retain its value.